Hello everyone. So now that we have completed module 1, we will have a comprehensive Q&A session on the first module where we covered the fundamentals of GST. Under this module, we covered the topics: what is GST and why was it introduced? Then what are the different types of GST, that is CGST, SGST, UTGST and IGST. Then we studied about the registration thresholds and who all are required to get enrolled under GST. And finally, we learned about the GSTIN structure and the compliance cycle, that is the due dates for filing of various returns and other compliances under the GST. So let us start with the Q&A session. So first question, imagine a manufacturer in Pune selling goods to a wholesaler in Mumbai, who then sells them to a retailer in Nagpur, and finally a customer buys the goods in Nagpur. Explain how the goods and service tax system ensures that the final consumer only pays the tax on the value added at each stage of this supply chain, illustrating the elimination of cascading effect. So we learned that GST was introduced to remove the cascading taxes effect, that is the taxes imposed on any other different taxes that were prevailing prior to the introduction of GST. So GST enabled the input tax credit mechanism and removed the cascading effect of taxes by the introduction of ITC throughout the supply chain. So the GST system prevents the cascading effect through the mechanism of input tax credit. Each business in the supply chain, that is manufacturer, wholesaler and the retailer, charges GST on their sales, that is the output tax liability, but can reduce this liability by the GST already paid on their purchases, that we call input tax credits. For example, the manufacturer pays GST on raw materials and claim ITC, that is input tax credit. The wholesaler buys the goods from the manufacturer, pays GST and claim input tax credit and charges GST on the sale to the retailers. Then the retailer does the same thing. This ensures that the taxes burden is only on the value added at each stage and the final consumer ultimately pays the GST only on the total value of the goods and not on the tax components embedded at the earlier stages. So let us take a small example. Suppose a manufacturer purchases raw material worth rupees 100, does the processing on the raw material and prepares the final product. The final product is ultimately sold to the wholesaler at a price of rupees 150. So here the manufacturer will charge GST on rupees 150 from the wholesaler. Suppose the GST amount comes to rupees 20. Also, he has paid GST at the time of purchase. Suppose that amount comes to rupees 12. So in this case, the manufacturer will have to pay rupees 20 minus 12, that is rupees 8 in cash towards the GST liability. Although his total liability will remain rupees 20, but he will discharge this liability by utilizing rupees 12 as the input tax credit and rest rupees 8 in cash. Further, suppose the wholesaler sells the goods further to a retailer for rupees 200. Then the wholesaler will charge GST on this rupees 200 and he will utilize the taxes that he has paid at the time of purchase from the manufacturer. So suppose if the GST charge comes to rupees 40 from the retailer, then the wholesaler will ultimately pay rupees 40 minus the amount that he has already paid at the time of purchase, that is rupees 20 in this case, and hence he will have to pay rupees 20 in cash only. So let us proceed to the next question now. A textile manufacturer in Gujarat sells fabric to a clothing brand in Rajasthan. Identify the type of GST applicable and explain the mechanism by which the tax revenue is distributed between the central and the state government. So we have already studied that intrastate supplies are those where sales takes place within the boundary of the state, whereas in interstate supplies sales takes place between two states, and in case of interstate supplies IGST is charged, and in case of intrastate supplies CGST and SGST or UTGST is charged. So when a textile manufacturer in Gujarat sells fabric to a clothing brand in Rajasthan, it constitutes an interstate supply because the supplier and the recipient are in the different states. In this scenario, integrated goods and service tax, that is IGST, is applicable. The IGST rate is the sum of the CGST and the SGST rates that would have been applicable on an equivalent intrastate supplies. Suppose if the rate of GST is 18%, then in this example, entire 18% will be charged under the IGST head, or had it been a intrastate supplies, then 9% would have been charged under CGST and rest 9% would have been charged under the SGST head. So IGST is levied and collected by the central government. The revenue from IGST is distributed between the central government and the destination state, that is in this example Rajasthan, based on the destination principle, ensuring that the consuming state receives the tax revenue. So the entire GST is shared between the central government and the state government in case of IGST. So let us now move to the next question. A trader in Uttar Pradesh deals in goods and has an aggregate turnover of rupees 45 lakhs in a financial year, which includes exempt sales and exports. Advise him whether he needs to register under GST and explain the concept of aggregate turnover. So we have already studied about the registration threshold limits. That is, in case of traders and manufacturer, this threshold is rupees 40 lakhs. So in case a trader or a manufacturer has an aggregate annual turnover of rupees 40 lakhs, then he is mandatorily required to get registered under the GST. Whereas in case of services, this limit is rupees 20 lakhs. So as a trader dealing in Uttar Pradesh, the registration threshold for GST is rupees 40 lakhs in this example. Since his aggregate turnover is rupees 45 lakhs that exceeds this threshold, he is mandated to register under GST. So in this case, the trader situated in Uttar Pradesh is mandatorily required to get enrolled under the GST. Then aggregate turnover is defined as the total value of all outward supplies. So in order to determine the aggregate turnover threshold, we have to include all the supplies, that is taxable supplies, exempt supplies, exports of goods or services, along with interstate and intrastate supplies. So aggregate turnover is defined as the total value of all outward supplies, that is taxable supplies, exempt supplies, export of goods and services, and interstate supplies of a person having the same permanent account number, that is PAN. This calculation includes all supplies made across India, regardless of whether they are liable to tax or wholly exempt. So to determine the threshold limit, we have to include all the supplies. So moving ahead with next question. Identify at least 5 categories of businesses or person who are required to register under GST irrespective of their turnover, providing a brief explanation for each category. So this we have already studied that who all are required to mandatorily get registered under GST irrespective of their turnover achieved. So, some categories of businesses or persons requiring mandatory GST registration regardless of turnover are interstate supplier of goods. So, in case a trader whose turnover has not exceeded the threshold limit of 40 lakhs but who is willing to do interstate sales transaction, then he is mandatorily required to get enrolled under the GST. So, any person making interstate taxable supplies of goods needs to register irrespective of their turnover. Then casual taxable person. So, casual taxable person are those who undertakes supply of goods or services occasionally at such places where they do not have any permanent place of business. Such person are also required to get mandatorily registered under the GST. So, individuals who are occasionally undertaking transactions involving the supply of goods or services in a territory where they have no fixed place of business. So, casual taxable person are also required to mandatorily get enrolled under the GST. Then non-resident taxable person, we call it NRTP. So, those who occasionally undertake transactions involving the supply of goods or services, whether as principal or agent or in any other capacity, but who have no fixed place of business or residence in India, are also required to get enrolled irrespective of their turnovers achieved. Then person liable to pay tax under the reverse charge mechanism. So, what is reverse charge mechanism? We have already studied about the reverse charge mechanism. It is a situation where the recipient of goods or services are required to discharge the GST liability under the RCM. So, recipients of certain goods or services where the liability to pay GST is on the recipient instead of the supplier. So, next are the e-commerce operators. So, operators who own, operate or manage the digital or electronic facility or platform for electronic commerce, that is e-commerce. So, e-commerce operators are also required to mandatorily get registered under GST irrespective of their turnover achieved. Then input service distributors. So, who are input service distributors? So, those who consumes the services centrally and afterwards distribute the input tax credits to the branches are the input service distributors. So, entities that receive input tax credit on behalf of their branches and distribute it to the other units are also required to get enrolled under GST mandatorily irrespective of their turnover if they wish to distribute the input tax credit to the branches. So, next question number 5. A small business owner in Tamil Nadu operates below the registration threshold but wants to register for GST. Explain the potential benefits of voluntary registration for their business. So, even if a small business owner in Tamil Nadu operates below the registration threshold, voluntary registration offers several benefits. Such benefits can be in the form of enabling input tax credit. So, voluntary registration allows the business to claim input tax credit on purchase of goods and services. It reduces the overall tax burden and potentially improve the profitability. So, if someone is registered under GST either voluntarily or mandatorily, the ultimate cost of product gets reduced. How? Suppose an unregistered person is buying goods for rupees 100 and paying GST of rupees 10 on such purchases. So, his ultimate cost becomes rupees 110. Now, when he sells the goods for rupees 200, his profitability will be rupees 90. Since he is unregistered, he will not charge any GST from the customer. Now, when the same person gets enrolled under GST and again purchases goods worth rupees 100 and pays GST of rupees 10 on such purchase. Now on sale, if he sells the goods for rupees 200, he will charge GST from the customer on rupees 200. Suppose rupees 20 comes to GST amount. Now his profitability will be increased as his sale value will be rupees 200 and his purchase cost will be rupees 100, because he will be claiming the input tax credit of rupees 10 that he has already paid at the time of purchase. Next, enhanced business credibility. Being GST registered can increase the credibility of businesses in the eye of customers and large businesses, potentially opening up opportunities for partnerships and expanding the customer base. So, being a registered SSE always attracts the other business houses for business relationships. Next, compliance with business to business, that is B2B requirements. Many registered businesses prefer to deal only with other registered businesses to avail input tax credits. Voluntary registration allows the business to cater to B2B clients who may insist on dealing with GST compliant vendors. So there are many business houses that prefer to conduct their businesses with registered vendors only. Next, interstate supply facilitation. If the business plans to expand into interstate trade in future, being GST registered is a prerequisite, making the transaction and transmission of goods from one state to another much smoother. So it is the primary condition that if a taxpayer wishes to do interstate transactions, then he need to get registered under the GST. Then access to export benefits. Registered businesses engaged in exports can claim GST refunds, providing a competitive edge in the international market. Since exports are zero rated and refunds can be claimed for the inputs or taxes paid as per the choice of LUT, access to business incentives in case of exports opens up for taxpayers. So next, moving to next question. So a farmer exclusively selling his agricultural produce, that is unprocessed, with an annual turnover of rupees 30 lakhs. Determine whether they are liable for GST registration and justify your answer based on the relevant exemptions. So the farmer selling exclusively unprocessed agricultural produce is generally exempt from GST registration, regardless of their turnover. This is because the supply of agricultural produce by an agriculturist is specifically exempt from GST. So an agriculturist is defined as an individual or HUF cultivating land by their own labor, family labor or hired labor under the supervision. However, if the farmer engages in processing or branding the produce or sells through commission agents in certain interstate scenarios, GST may become applicable on those specific transactions or services. So in this case, the farmer who is exclusively selling his own agricultural produce will not be liable to get enrolled under GST even if his turnover exceeds the basic threshold limit of rupees 40 lakhs. Next we have question number 7. Explain the structure of a 15-digit GSTIN, that is Goods and Service Tax Identification Number, detailing the significance of each part of the number. So this we have covered in our module 1. The first two digits of the 15-digit alphanumeric code, that is the GSTIN, represents the state code as per the Indian Census 2011. For example, 27 is for Maharashtra. So any GSTIN that starts with numeric number, that is 27, denotes that GST registration belongs to Maharashtra state. Then next 10 digits, this is the permanent account number, that is PAN of the taxpayer, establishing a link to their income tax identity. So here we also need to note it down that the fourth character of the PAN represents the constitution of the business. For example, if the fourth character of a PAN is P, then it represents person, that is proprietorship business. Similarly, if the fourth character is F, it constitutes firm. Then if it is T, it will mean that the constitution of the institution is trust, and C represents company. Also, the fifth character of the PAN represents the first alphabet of the surname in case of proprietorship or HUF business, and in case of other businesses it represents the first alphabet of the name of the institution. Next, the 13th digit in GSTIN, it indicates the number of registration the entity has within the specific state under the same PAN. Example, 1 for the first registration, 2 for the second registration. So if certain entity has 5 registrations, each for its branches within the state, then the last registration that would have been taken will have numeric 5 in its 13th digit. Then 14th digit, usually the letter Z reserved for potential future use, and 15th digit is the checksum character, which can be an alphabet or a number used for error detection and validation. So this is the structure of a 15-digit GSTIN. Next, describe the compliance cycle for a business operating under the GST composition scheme, specifically focusing on the returns they need to file and their periodicity. So to answer this question, we need to first understand who are composition dealers. So the taxpayers whose turnover has not exceeded rupees 1.5 crores during the preceding financial year can opt for composition scheme, where they have to pay a certain percentage of their turnover as GST composition fee. So a composition dealer cannot charge GST in their invoice. Also, they cannot avail the input tax credit on their purchases. For example, in case of manufacturers and traders, the rate of GST to be paid by composition dealer is 1%, that is 0.5% under CGST and 0.5% under SGST. Similarly, in case of services, this rate is 6%, that is 3% and 3% under each heads. So businesses opting for composition scheme have a simplified compliance cycle. They are required to file quarterly statement in the form GST CMP 08 by the 18th day of the month succeeding the quarter. For example, the due date for filing of quarterly return for the quarter ended 30th June will be 18th of July. Then they must also file an annual return in form GSTR 4 by April 30th of the following financial year. So in the previous budget, this 30th April has been revised to 30th June. So the due date for filing of annual return by composition dealer informed GSTR 4 is 30th June. Then composition dealers cannot claim input tax credit and must issue a bill of supply instead of a tax invoice stating that they are composition taxable person and not eligible to collect taxes on supplies. So a bill of supply is required to be raised by the composition dealer instead of tax invoices. Moving ahead. Identify some of the primary challenges and criticism associated with the GST implementation in India, considering its impact on different sectors and businesses. Despite its benefits, GST implementation in India has faced criticism and challenges. These include complexity arising from multiple tax rate slabs like 0%, 5%, 12%, 18% and 28%, which can be confusing for businesses, especially small and medium-sized businesses. Small businesses in particular found adapting to online compliance and the increased need for digital record keeping challenging. Technical glitches and system downtime on the GST network also caused delays and frustrations. Discrepancies and delays in input tax credit reconciliation and refunds posed cash flow issues for many businesses. The exclusion of certain sectors like petroleum products, alcohol, real estate from GST's purview has limited its one nation, one tax objectives. There were also concerns about increased input costs for sectors where previously exempt items became taxable and a lack of sufficient awareness and training among some businesses. The anti-profiteering clause also raised questions about its implementation and impact on pricing. So initially, when GST was introduced, it faced criticism and resistance from different stakeholders. The GST portal was not working smoothly and it caused frustration among the taxpayers. It brought complexities and enhanced the compliance requirements with monthly or quarterly filings and annual filings, annual reconciliations, annual audits, and so on. Many challenges were prevailing at the time of implementation of GST, but gradually as the time passed and as the system got smoother, the nation accepted the GST and now the taxpayers are able to do the compliances on their own due to the simplicity of the portal and the entire GST mechanism. Moving ahead, discuss the various GST rate slabs applicable in India, highlighting how the government differentiates between essential goods, common items and luxury or sin goods based on these rates. So, India's GST system has several rate slabs like 0%, 5%, 12%, 18% and 28%, and some specific rates like 3% for gold and 0.25% for rough precious stones. The government uses these slabs to tax goods and services based on their nature and essentiality. For example, 0% essential goods like milk, fresh fruit and vegetables, and education and health services are exempt to keep them affordable and accessible. Then 5% under this bracket, basic necessities like coal, edible oil, tea, life-saving drugs and some services falls into this category to ensure affordability. Then 12% and 18%. These are standard rates for a wide range of goods and services. It includes packaged foods, mobile phones, capital goods and most consumer products aiming to balance revenue and reasonable consumer prices. Then 28% luxury items and sin goods like luxury cars, motorcycles, aerated drinks and tobacco attracts high tax rates, sometimes with an additional cess also to discourage consumption or tax luxury spending. So in this way, government uses the tax rate to tax goods and services on the basis of their nature and essentiality. So any confusion regarding the rates can be clarified using the official website of goods and service tax, that is www.gst.gov.in, or while entering the CBIC official website. So that's it for this module. We have this much of question, and going through these questions, we revised the entire module 1 along with the practical exposures. So thank you very much.